Ben Reynolds is the founder of the Sure Dividend newsletter, which he's been publishing for more than a decade. In this conversation, Ben shares his 8 rules of dividend investing. We reminisce about old school dividend blogs. Then we talk about winners and losers over the years, including some of the recent high-profile dividend cuts. Stick around to the end. Ben shares his top 3 dividend growth stock picks right now. There's also a free download in the description. It's a spreadsheet with a list of the 54 Dividend Kings. Those are companies that have paid and increased their dividend for the last 50 years or more. With that, here's my conversation with Ben Reynolds. Hey everyone, I'm Craig from Retired Before Dad. Today I'm talking to Ben Reynolds from the Sure Dividend blog and investment newsletter. Ben, thanks for joining.
Thanks, Craig. Happy to be here.
All right. We kind of go way back. We've been blogging for a long time. Before we jump into the questions, tell me a little bit about yourself. Where are you based? Kind of what's your background?
Yeah, I'm based in Houston, Texas. Grew up here. I've lived here my whole life. My background, well, for the last 10 years, I've been running Sure Dividend. It's been since 2014. We actually just had our 10-year anniversary of the Sure Dividend newsletter last month in April. So it's been almost exactly 10 years. It's been a long journey. But also, I can't believe it's been 10 years. The time goes quickly. Prior to Sure Dividend, I worked at several different jobs outside of the investment industry. And I also got a Series 65. I was planning on being an investment advisor, but I realized my skill set was more on the research and analysis and writing side and less on the sales side. So I did Sure Dividend instead of pursuing an investment advisory career.
All right, so I want to take us back to 2012, 2013. I mean, this was like the heyday of dividend blogging. I was reading lots of different dividend blogs. This is before Fire really got popular and certainly before YouTube exploded. I was reading blogs like, Dividend Mantra, Dividend Growth Investor was certainly active back then, Dividend Ninja. I remember one called Dividend Growth Machine that I really liked. Were you reading those blogs back in the day? And how did you leave that and decide to go with Sure Dividend?
Yeah, so I wasn't initially reading those blogs. I did read them. My favorite was Dividend Growth Investor. He's still active, or they're still active. So yeah, I really enjoy that site. I read several others, Dividend Mantra as well, which I know that site got sold and is no longer really active. But I didn't really come to dividend investing and dividend growth investing through those sites. I learned about them afterwards. I came to it more from I was looking into the different market anomalies and what kind of works in investing. And I was looking at low volatility. I was looking at value, low price earnings ratio, and looking at quality. And then I was reading a lot about how Warren Buffett invests and looking at his portfolio. And I noticed that dividend growth stocks line up with low volatility. And, depending on when you buy them, some of them have low price to earnings ratios and they're higher quality. And Warren Buffett's portfolio at the time and still today is filled largely with dividend growth stocks. So I thought there's something to this. And that's really what brought me to it and made me get more interested in it.
And you said you had multiple jobs and you had a Series 65. What was it? What were you doing directly before you started Sure Dividend? And then, how did you decide to make that jump?
So after graduating college, I have a finance degree from University of Houston. I worked in doing warehouse sales. It was a family company. It's no longer around, but at the time, that was kind of like my planned out life path, I guess. So I didn't really think about it. And I was like, okay, I'm going to work in the warehouse industry after I graduate. I did finance because I liked finance, not because it was going to really help me in that career. And after a couple of years, I was just thought this isn't for me. So I left that and I wanted to start. I've always been very interested in investing. While I'm working there, I'm reading about investing, thinking about it. I'm investing myself, not with huge sums. I'm just out of college here. But I realized I wanted to be in the investment industry. So at that time, I actually got my Series 65 and thought I was going to start my own investment advisor firm. And I actually did. It was called Rose Investments. I did everything. I got the whole thing set up, registered, licensed in Texas. And then I realized, how do I get customers? And I could not. I didn't know any, I was like, I don't know how to get customers. So that didn't work out. I took a different job, basically being someone's assistant for an unrelated field. And then after 6 months of that, I kind of got the idea for Sure Dividend. And my wife and I actually sold our house and used the proceeds to, it's very risky, but it's kind of like a do or die my thing. I was like, this is my shot, my chance to have my own company and like, start my career that way. And I started it then, and I realized quickly I was writing for Seeking Alpha a lot. So like, okay, I can make some money writing for Seeking Alpha, probably not enough to live on, but some. And then that brings traffic to Sure Dividend. And then that's how I was able to start Sure Dividend was through writing on Seeking Alpha and building it while getting paid to do so.
I interned at Merrill Lynch at one point. I guess I was a junior in college, and I was all excited to get into this investment office. I thought that was going to be my career path, and I partnered up with this financial consultant. And halfway through the summer, I was just only doing copying and sales and helping him to manage his leads. And at some point I was just like, when are you going to buy a stock for somebody? Like he didn't buy any stocks. He just didn't do any research. It was all about sales. And that's when I realized it wasn't for me, the investment world. But then later on, I also thought about becoming like a CFP and like a fee-only financial advisor. And then I bought a condo that was just way too expensive, and I couldn't afford to leave my career anymore. So I kind of had a similar, thought that I'd go into the investment world, and I'm definitely glad I didn't. So whenever you started Sure Dividend, then, a lot of us, the blogging business model was, drive traffic, ads, affiliate model, and you went like directly to the subscription model, which in hindsight was the right way to go because that's much more sustainable. And really, that's kind of where things still are, these subscription models. But I remember you were reaching out to like all the different dividend blogs and writing guest posts. Obviously, it was for SEO, which I didn't know anything about at the time. But like, how did you know that strategy was the way to go, to just do the guest posts and get the link back to your Dividend Aristocrats? Like, how did you learn about that strategy?
I didn't know about it beforehand. I knew almost nothing when I started, but I learned a lot from the site Backlinko, which was run by Brian Dean. And so, yeah, I learned a lot of the guest posting and link building for SEO purposes through that site. So I was just kind of like, okay, this works. I hope it works, I guess. And our search traffic started going up. So I was like, okay, this is a good thing. And it would make sense to work because, you're writing for sites where the audience is the same audience you're trying to reach. So even if it doesn't do anything with SEO, it's probably beneficial, and you get to build relationships with the people in the same, doing the same thing as you, which is cool.
Yeah. I mean, that's kind of how the model went for the next decade. I think a lot of the dividend bloggers were just kind of doing it for fun, or, we thought we could build like another passive income stream with ads and in the blog, but blogging is obviously much different nowadays. But a lot of it does still go back to SEO.
I never really I never thought of Sure Dividend as a blog. I always thought of it as a newsletter business. So for me, it wasn't, I didn't put myself out there personally. Like I didn't use my name hardly at all to start. I still don't, but like, it wasn't like Ben Reynolds' dividend journey. It was Sure Dividend to help people build their portfolios. Because from the start, my thought process was what will work well for an individual investor, where it's not super hard to screw it up. You're likely to get at least pretty good results. And then with dividends, it provides what you actually need in retirement, which is income, which is nice. So I thought this is the best way to serve the individual investor at a super low cost. Because before I was thinking about, investment advisory and the fees they charge. If you charge 1% on $1 million portfolio, that's $10,000 a year, versus a newsletter. Even a very high price newsletter is not going to be anywhere close to $10,000 a year. I mean, it definitely shouldn't be. There might be a few subscriptions out there at some of the larger companies where I've seen crazy prices, but the idea is that you can get really quality investment information, implement it yourself at a very tiny fraction of the cost that you'd get from like you were talking about, someone who's focused on selling and not on actually finding good investments.
Okay, Ben, so tell me about the Sure Dividend way, or the 8 rules of dividend investing.
Absolutely. So yeah, when I started Sure Dividend and still today, I came up with the 8 rules of dividend investing. And these are all based on either practitioner and or academic research. So they're not just kind of pulled out of a hat. There's 5 buy rules, 2 sell rules, and a portfolio building rule. So I can briefly go over very briefly each one. So rules 1 through 5, the buy rules. The first one's about quality. And I take a sort of a different approach to quality, where we're looking at dividend history. And the idea is the longer a company can increase its dividend year after year, that shows greater and greater evidence of a durable competitive advantage. I'm sure it's not easy, but it's increasing your dividend for 3 or 4 years in a row. You could be in a favorable industry at a favorable time and the growth's just kind of easy. But if you can increase your dividend for 20, 30, 40, 50 years, that shows that at least up to now, the company's been able to withstand a wide variety of different economic situations, recessions, massive changes going through, pre-internet to internet to now AI. The company's been able to increase its dividend through all of that. It's a very good sign about the quality of the business. So I see dividend history as sort of a proxy for durable competitive advantage, which is very important for a long-term investment. So that's the first rule, and quantitatively, that's to measure years of consecutive dividend increases. The second buy rule is the bargain rule, and that's just to look at stocks where it's the dividend yield. All other things being equal, higher yield the better. So we'd rather have a stock that yields 4% versus one that yields 2% if everything else looks the same. The third rule is the safety rule, which is it's a riff on the Benjamin Graham's idea of margin of safety. But here we're looking at margin of safety in regards to the dividend. So we're looking at low payout ratio. And the combination of a high dividend yield and a low payout ratio actually is a low price to earnings ratio. So it kind of backs into a value strategy. The fourth rule is the growth rule. And here you're looking at dividend growth stocks. So we'd rather have higher growth than lower growth. Sure Dividend, we measure growth on a per share basis, typically earnings. It's important to make the distinction. A company, you see this a lot in the REIT world, but a company can issue shares and earnings per share can go down while total earnings for the company can go up. We measure on a per share basis. The fifth rule is the peace of mind rule, and that's another kind of proxy for quality is low volatility. So we'd prefer stocks with lower volatility. And lower volatility stocks, there's some studies that show they have actually outperformed despite having lower risk. So those are the buy rules. We use them to varying degrees in our different newsletters. We have different newsletters focused on different kind of facets of dividend investing. But our two sell rules are the overpriced rule. So that's the higher the price to earnings ratio, the better it would be to sell, because if something's very overvalued, it might make sense to kind of cash out and invest in a stock with a lower valuation, leveraging the optimism and pessimism cycle of an individual stock. And then the seventh rule, the survival of the fittest rule, that's basically looking at selling when the dividend is either very risky or reduced. If we're buying stocks for rising dividends, if the dividend isn't rising, it's a good time to sell. Or if the dividend looks like it's about to be reduced, it's a good time to sell. In a perfect world, we'd always sell before the dividend is reduced, but in practice, that's not always possible. And the final rule is the portfolio management rule, and that's to diversify. If you have a dividend portfolio of two stocks, that's very risky. You don't want to do that. So there's kind of a sweet spot between too much concentration where you're taking excessive risk and too much diversification where you can't cover and really know 300 stocks. So we shoot for 20 to 30 stock portfolios. That gets you almost all the benefits of a much greater amount of holdings while still being able to focus on your better ideas.
Yeah, I think that's one of the challenges with dividend investors is, and I'm guilty of this, but I accumulated 50 or 60 stocks, and now it's hard to monitor all those. It's mostly reading, earnings reports every quarter. I use your newsletters to help me just keep an eye on things, because it is hard to follow 60 stocks. Now with dividend investing, though, we like to have the diverse income streams and seeing all these dividend payments coming in. If you've got 60 stocks, that's more payments than you're going to get if you have 20 or 30. Myself, I'm looking to reduce mine and maybe introduce some ETFs, or I have introduced some ETFs, and maybe we'll talk about that a little bit later. But I know like a lot of the growth stock strategies, they try to stick around 25 really at the max. I think that's just a capacity thing. Or, you can only spend so much time on your investments. I used to spend a lot of time on picking stocks and researching stocks, but now that I'm kind of busier with my kids and my business, it's just not what I want to be doing, researching stocks all the time. That's why the newsletter is a shortcut for me, where I can read your newsletter every month and make investment decisions based off of that, or using that to help drive my decisions. I wanted to ask you about volatility. So you mentioned you're looking for low volatility, and that was something you were doing really even before you started the newsletter. Are you just looking at beta for that, like based on the S&P, or do you use other volatility metrics?
The specific metric we use is the daily standard price deviation deviation over 5 years, daily price standard deviation over 5 years. So it's very similar to beta. None of these metrics are all that different. They measure virtually the same thing. Beta just measures against the S&P 500, whereas price standard deviation just measures against price itself. Extremely similar, you're not going to see any changes really switching one to the other. But that's the one we use. And we use a 5-year look back. It doesn't make that much difference really, but that gives a good history.
Okay, Ben, so tell me about the different newsletters that you run. I know when you launched, you just had the Sure Dividend newsletter, and that's still your foundational product. But tell me about all the different newsletters that you publish.
Absolutely. So Sure Dividend has evolved over the years, like you just said. In 2014, we had the Sure Dividend newsletter, which was a newsletter I did all of the research and analysis for and published monthly. Now we've expanded over the last decade. We have a team of 15 researchers who analyze more than 800 different dividend stocks and related securities like REITs and MLPs every quarter. So all that data and all that analysis, we call it the Sure Analysis Research Database. So our team actually makes 3-page PDF reports on all of these 800 plus securities. And we're continuing to add securities over time as we grow. But we analyze and measure all these companies over the same metrics so we can compare very different types of income securities. As an example, we could compare a very slow growing but high yield MLP to a fast growing dividend growth stock with a much lower yield on an apples to apples basis to determine which looks like the better buy or sell. So that's kind of the core of what powers our newsletters now is the analysis we do in Sure Analysis. So then from Sure Analysis, the data goes into, we have 5 different newsletters or reports. Our most popular and flagship newsletter is the Sure Dividend newsletter. That's our kind of core dividend growth. You could think of it as sort of balanced between yield and growth. Then we have the Sure Passive Income newsletter, which is focused more on growth, still dividends, but the yields are going to be lower than the Sure Dividend newsletter. And on the opposite side of that, we have the Sure Retirement newsletter, where the growth is going to be lower, but the yield's higher. All of our newsletters focus on long-term buy and hold investing. So none of these are trading quick in and out. Ideally, we'd like to hold forever. And our sell rules, we're switching to the only sell rule we'll have is if a company does not increase its dividend on an annual basis. So we're really optimizing for dividend growth specifically. So those are our 3 core newsletters. And then we have 2 report services that also come out monthly. One is the Top 10 Dividend Elite, which is similar to the Sure Dividend newsletter. It just doesn't have as much detail. It doesn't have a portfolio building guide. It's more of an intro level idea if you're kind of just looking for some stock ideas. And we also have the Top 10 REITs report, which doesn't, again, have a portfolio building guide. And it's more for ideas on REITs to buy, because REITs are kind of a different subcategory. So those are our services, and they're kind of all powered by the research our team does. We're not just scraping data from some other site. We're actually analyzing these companies and making our own metrics in a lot of cases. And obviously we do get data from elsewhere too, but it's a combination.
So you mentioned the Sure Dividend Research Database, and that's a product that readers can sign up for. It's just like a massive spreadsheet that has lots of data in it, and you can put your portfolio in it. And so you guys use that to then build the newsletters. Is that right?
Yes. So we have a spreadsheet that updates daily, and then we have the 3-page PDF reports that our team makes for each stock. So you can drill down to look at the actual analysis on a specific company and where those numbers came from.
You're in the business of recommending stocks, right? And so there are investors, especially if you go to YouTube, people just want to know what are your favorite stocks. And we're going to say, if you're going to have 3 top stocks for us at the end of this interview, so stick around and Ben's going to give you his top 3 picks. But going back to 2014, I was looking at the S&P recently, and it's done really well. So back when we were blogging about dividend stocks, if people were buying them, there's been mostly pretty good outcome. It would have been your, some of your top picks or some of the best picks that, in hindsight have really performed well. And don't worry, we'll get into some of the bad picks as well. But do you have any standout stocks that you remember picking early on that you're like, wow, that was a really good pick. It really became the stock that we hoped it would become or better?
Caterpillar stands out. I know that one's probably our highest returning pick.
Really?
Yes. I don't remember the exact year, but it's a long-term, maybe 9-year holding, and I think it's up something like 5x. I'd have to look at my numbers exactly, but it's definitely performed very well.
That's sad because I sold Caterpillar years ago. They just had too much
Yes.
debt for me. The debt was just too high. I remember analyzing it, and I don't think you guys really look at debt as much in your picks, but that's one of my standout metrics. And I've always just seen their debt level to be too high. Of course, debt was cheap, so I guess it's kind of worked out for them.
It did. So yeah, and that probably speaks to why it worked out so well, is because it was a bit of a higher risk, higher return proposition where, in a different world, if we would have had a 5-year massive recession and, everything went bad and interest rates went way up, maybe they wouldn't have made it. So that's why it's always a little tricky looking at one pick. Several of our picks, March and April of 2020, have done extremely well too, which is more about timing, which we didn't say go all in right now in, March 20th of 2020. No, actually, scratch that. That's exactly what I said. No, we recommend just kind of consistently buying over time. But the picks that were from that time period did do very well, just because there was a lot of panic in the market. And then when the market recovered, those picks did well.
Do you remember any of those? I remember Boeing going, I don't think that would have been a pick for you guys, but Boeing went way down and I thought about buying it. But do you remember some of the other ones that went down around that time? And this is, of course, COVID, March 2020.
Unum Group was one that's done very well for us. A lot of financials. Polaris is another one. They do motorcycles and ATVs. And that's a weird company because you hear motorcycles and ATVs and you'd think super cyclical, wild results. They're very consistently profitable even in recessions. They have a 25 plus year dividend streak. That one did very well. That's one that the market often will underestimate. Just the results don't kind of match what you'd expect. Several banks as well did very well at that time. But yeah, almost across the board, if you were investing during that time, you probably did well. And energy in particular did extremely well. We weren't recommending many energy stocks at the time, unfortunately, but that sector did extremely well.
All right. So yeah, we talked about some winners. Again, you're in this business of recommending stocks and like nobody bats 1,000, right? So I guess start with maybe like some of the older ones that you recommended, and then maybe we can talk about some of the more recent ones, because I know I've held a couple dogs. Especially this month, we learned about a couple who I'm sure you've probably recommended over time and have cut their dividends. So let's talk about maybe some of the losers. And I'm wondering if you ever get feedback from readers of your newsletter, just like, why did you pick this stock? And if you ever get any messages from people about those picks, you never hear from the winners, right? But maybe some of the losers.
In regards to feedback, we actually get a lot of people writing really positive stuff. We have a testimonials page on our site. Most of those we didn't ask for, but a lot of people are surprisingly appreciative, which always makes me feel like I'm on the right track. And yes, we definitely have people writing in confused, upset, frustrated too. It's actually much more positive than negative. Our newsletters actually have from what I can tell, a much lower churn rate than the industry average. So people tend to stay with our services longer than the typical newsletter reader, because I do try to do things in our readers' best interest. And so a lot of our audience does understand there will be companies that we recommend that reduce their dividends. And I did definitely want to touch on a couple different ones. The one that stands out as one of our all-time worst investments is multiple failures. It was a series of failures. Is Owens & Minor. It's a small stock. I think they had 25 years of dividend increases when we recommended them. They had just done one or multiple big acquisitions, and their stock price had come down. They had high debt from the acquisitions, but they also had a strong earnings stream. The cash flows were not there though. So we actually redid a lot of our stuff to always check for cash flows after Owens & Minor. But they reduced their dividend. I don't believe we've sold right away. We might have. I don't recall off the top of my head, but the price went down like 90% from peak to trough. Massive.
I remember that company. I don't know if it was not just one that you were recommending, but one that a lot of dividend bloggers were writing about. And I remember thinking like, oh, I got to buy that one. And I never got around to it, I guess, thankfully. Are they like a medical delivery company or something like that with very, very low profit margin?
Yeah, that's very accurate. So we recommend it. Stock price tanks, dividend gets cut. We recommend selling it somewhere near I have to check my notes, but we'd be geniuses if we did this in reverse. The timing was impeccably bad. So the stock collapses. People think it's going bankrupt. Fast forward, I haven't checked it in a year or two. So, I don't know what's happened lately, but fast forward a couple of years, the stock price more than fully recovers. I believe they reinstated the dividend, and it was like a 10-bagger on the upside. So that one was frustrating in multiple ways. That's probably our all-time worst investment. Another one I want to highlight, a different mistake, a more recent mistake. We actually haven't exited the position in all of our newsletters recommendations yet. We also have a real money portfolio, so I believe we still have the security in the real money portfolio. When AT&T spun off Warner Bros. Discovery, we didn't sell that immediately, even though they didn't pay a dividend, and that was a huge mistake. That's down significantly. We would have been much better off to just say, hey, they don't pay a dividend, get out. I didn't recommend selling because I thought it looked cheap when they spun it off. It can get much cheaper, is what the market showed.
It can always get cheaper.
Yes. So that one, they've struggled, and it's a different mistake of getting a security that we didn't recommend buying on its own right. I mean, we would never recommend a stock that doesn't pay a dividend at Sure Dividend, obviously, but we should have just exited immediately. And I think a lot of our mistakes have been on the value side, where we're like, for me, I'm making these mistakes. I shouldn't say we. I'm looking too much at value and like, oh, this is cheap, hold it, wait for a better price to sell. And that's been a mistake a lot of times, or I can trace that back to a lot of our mistakes. And in the case of Warner Bros. Discovery, WBD, they were I thought they were undervalued. It went down more, but one of the reasons for holding initially was spin-off stocks tend to outperform. There's a lot of evidence for that, but it's not always the case. And I thought it would be the case here based on the valuation. So that was a mistake that, just not focusing on what our mandate is and what we should be focusing on, dividend growth. Getting outside of that tends to wreak havoc. So that's a second mistake I wanted to talk about. And the final mistake is, I feel like these are somewhat, to some extent, unavoidable if you're a long-term investor. The best two examples would be 3M and Walgreens. 3M had a 60-plus year dividend streak, which they just announced is going to end like a week ago. And Walgreens had I think at least 30-plus, if not 40-plus year streak that ended maybe a year ago. If you're a long-term investor, like we recommended 3M initially, I think 9 years ago, almost 10 years ago. So 9 or 10 years ago, the company looked very strong, and it was. We didn't get to recommend it often because it was so strong. If you had asked me, I'd say 3M, Johnson & Johnson, Procter & Gamble, Coca-Cola, like those are like the core. If you think of a dividend growth stock that's super safe, I would have said 3M is one of those.
Yeah, it was safe. And it was low debt and just very strong. But they've run into some legal stuff, right?
No, they've had a series of lawsuits. They had their combat arms settlement. They sold the U.S. military a bunch of defective earplug devices, I guess. I don't know the specifics. I'm not in the company, so you'd hope they didn't do that intentionally or knowingly, but that's very sad for the people that wore those devices and didn't have their ears protected from sound damage. That was a huge lawsuit. They've contaminated the water supply with chemicals that are in like fire retardants. And so that's a multi-billion ongoing settlement. So they've had these issues. I think that settlement's over 10 billion. And the company, as of now, based on my estimates, and I could be really off on this because it's legal stuff, but I'd estimate they've settled about 2/3 of these lawsuits on a cash basis. The company is, in my mind, certainly going to survive, 95% plus chance. They're still paying a dividend. They didn't slash their dividend to zero, but it's really these lawsuits that damaged the company. And I thought, and we recommended it recently too, I thought there was a good chance they'd be able to keep their streak alive. But when their spinoff, recently did a spinoff, and when the Solventum spinoff that company didn't immediately announce a dividend payment, that almost certainly meant 3M was going to reduce their dividend, which they did. So it's kind of sad to see a 60-plus year streak end. And I guess the point on that for me is, if you're a long-term investor, no one, maybe someone, but who's going to have the foresight to say 10 years from now, this company's going to get in some legal issues? That's beyond, I think, the scope of what anyone could possibly expect to know. And that's one of the unfortunate things. There are no guarantees in this. And that's why it's so important to have diversification.
Yeah. Yeah. I mean, I'm not trying to point out your losers like specifically, but there's real lessons to learn from those. Sometimes the writing's on the wall. Leggett and Platt's the other one that dropped, they cut their dividend dramatically this month or in the last 60 days or so. I've held that one all through it, even though the writing was on the wall, the yield had gone up. And I know you guys issued a sell on both of those. And it's tough to sell one like 3M. I'm not selling 3M yet. Leggett and Platt, I did sell recently. Walgreens, I think I sold like half of that. I'm going to probably sell that one too. So those were tough ones, but these are stocks in a larger portfolio, and you just have those issues. I remember back in 2007, I only owned like 12 stocks. going into, and I think that was like a Kramer thing. I watched Kramer on TV, and he was like, you only need like 15 stocks or 20 stocks, and I was at 12. And one of those was Bank of America. One of those was a REIT. It was called iStar Financial. And just those two stocks, 1/6 of my portfolio just got absolutely, crushed. And I was held, I still had my Coca-Cola and my Chevron. But when that happened in 2007, that's when I really decided like I needed to build this up, because those two stocks really, really brought everything down, and they cut their dividend. It happens. And that's why you hold a lot. I think 30 is enough to withstand like one or two. You can add maybe some ETFs to that, but a lot of hard lessons out there for any investor, no matter your strategy. There's going to be hard lessons learned.
Absolutely. And I do actually enjoy talking about the investments that didn't work out, because I feel there's a lot more to learn there versus like, hey, this worked great. I mean, it's interesting to see why a company fails, and it's interesting to see why a company succeeds. Those are both very interesting things to look at.
So I kind of want to change a little bit here. So going, when you're a dividend investor, we do this because the market's pretty crazy, but the dividend is something that you can sort of rely on, right? I mean, Coca-Cola, I know they're going to pay me. And so back in the day when I started doing this, I was always measuring like, here's how much income I'm going to earn this month. Here's the projected 52-week income. And so that's what dividend investors like about dividend investing. And there's some evidence that dividend stocks outperform other stocks. But when you invest in dividend stocks, you're never going to pick the next Tesla or the next Nvidia or Monster Beverage. And so other newsletters like the Motley Fool, or like those types of growth newsletters, they really live and die on that one pick that's gonna just explode. Like, oh, I bought Amazon in 1999 and held it. Like, well, great, then your portfolio is gonna outperform like any dividend portfolio. But one of the things about dividend investing, I think it is frustrating, is that you're never going to get that next big increase. So like, what's your take on growth stock investing, where they don't pay any dividends a lot of times, versus following the dividend growth model?
Yeah, it's an interesting question, and it's really nuanced. My first thought is that there's a lot of different investing styles. Virtually any of them can work for different people. It really depends on your temperament and what you're focused on. For growth investing specifically, over the last 10 years, it's done extremely well. If you take a longer view, historically, stocks with high price to earnings ratios have significantly underperformed. So it's likely we've seen an aberration in the last decade-ish of time where these growth stocks have just crushed everything else. I don't know if it will persist, but that's one thing to think about. If with any strategy over a very long period of time, is there evidence that it works pretty well? And I guess the good thing about investing is almost everything works pretty well over a long time in the stock market, because stocks go up in value over time in aggregate, because I think that kind of ties back to human innovation and people actually working to make value, and we get more efficient over time as a society, and the stock market reflects that. And I think that's something that hopefully doesn't change. But yeah, I think that if you take a long view, growth investing probably doesn't look like it does as well, but it's certainly outperformed dividend investing recently, as in the last 10 years. I think the real appeal to dividend investing for me and for a lot of people is what you touched on, is you can look at the dividend and ignore the stock price to some extent. So if you're investing for dividends, you're investing to build an income stream, not to kind of play the game of the market. And that means if you think of it that way, you're likely to be able to hold during big dips. Whereas it's easy to say, hey, I held Amazon since it IPO'd. That stock had a 90% decline in like 2000 or something. So maybe you held it, maybe someone did. A lot of people didn't. And with any newsletter too, it depends how many stocks they recommended, and you can kind of play games with how you measure your performance. So yeah, those are my thoughts on kind of growth investing versus dividends, and really any style of investing.
Yeah, I mean, you can say crypto, you could have bought Bitcoin 10 years ago and done really well. There's always some alternate strategy. There's always somebody on YouTube who's going to tell you it's the best strategy now. I think the recent run in Nvidia and Tesla in particular have been like really compelling. I mean, Tesla's come down quite a bit, Nvidia's come down, but I was doing some research on the QQQ, the Nasdaq 100 ETF, and it actually has really outperformed the S&P. So I think there is some validity to that strategy. Although like you don't want to chase it now because the QQQ is way above the SPY right now. Doesn't mean it's going to last. So I think when things reverse, that's going to be the time to reverse strategies, when maybe the market corrects and that those Qs are going to go down, like the Nvidia when it's super overvalued, but it's got an amazing business, an amazing sales channel. It's just, there's no dividend. So a lot of people don't pay attention. I mean, Microsoft started, eventually these companies started paying a dividend. I think even like Facebook started paying one, and even Google is finally.
Nvidia technically pays a dividend. I think they have a 0.1% dividend yield. So I wouldn't call it a dividend stock, but they technically have a dividend. And Alphabet just announced their dividend, I think a week or two ago, and Meta a couple months ago. So, and Microsoft pays a growing dividend. Apple has a growing dividend. So as of now, dividend growth investors could be in those stocks. But as you touched on, they're not. Apple at some points has been a traditional dividend growth stock. I wouldn't say it is now, but there's definitely been times where it had like a reasonable yield, lowish price to earnings ratio. And we never recommended it. I wish we did. But a lot of people, that definitely would have qualified as one. And Microsoft too, like a lot of these companies 10 years ago, their price to earnings ratios weren't that high. And like Microsoft, people were very concerned about its future, which now less so.
Well, it's really innovated. It's really like adapted to the times. Yeah, Apple's my top stock purchase that I've held since 2013. The sad thing is I bought it in 2007 or 2006. And I remember, I made like 20%. And I was like, well, I better sell this on this rumor that a phone's coming out. And I sold Apple like literally like right before the iPhone came out. And I bought it. I waited 6 more years to buy it back, and I'm still up like 1,000%. But they had a really great streak on the dividend too. I think it was like 10. It was like 10% for almost 10 years. I think this year was only about 4%. But yeah, that's been my top stock, and I never would have guessed that back then. So what is your take on? There's these really popular dividend ETFs, especially on Twitter. Yeah, you see them all over YouTube, but there's a couple of these dividend ETFs that investors love. One is Schwab, the SCHD. There's the VIG, that's the Vanguard Dividend Growth. And then recently there's the JEPI, right? JEPI, that's a JP Morgan covered call ETF. Like, what's your take on some of these dividend ETFs? And then as an alternative strategy, like myself, I'm kind of moving towards some dividend ETFs because they just take a lot less work. But what's your take on those dividend ETFs?
That's a good question. So we don't cover ETFs or funds at Sure Dividend. I don't think they're bad at all to invest in. They can greatly simplify things. So the main things to look for are the expense ratio on the ETF. Obviously, the lower the better. I'm sure Schwab's is very low, whereas some of the other ones might be a little bit higher. But expense ratios do eat your returns. So one of the most assured ways you can increase your performance is to minimize investing fees. So as long as the ETF or fund in question has a very low expense ratio, that's one thing to look for. My take on funds versus individual stocks in general, outside of the discussion on fees, which it depends on the fee, can have a major or minor impact. Outside of the discussion on fees, it's really about the mindset you have investing. So if you don't want to think about businesses or your investments, I think ETFs are phenomenal. If you're more interested in business in general, I think it's interesting to invest in individual businesses because you learn about them and you learn about the business world and what works. And then I personally think, so there's two sides to this, but I think it's easier to hold individual stocks. If you're in a recession and you're talking and it's like, okay, well, people are still shopping at Walmart. Like that's it's easier in my mind to say, okay, Walmart hasn't reduced their dividend. People are shopping there. I'm going to hold that stock. I don't really care what the stock price is doing right now. With the ETF, for me, it's more of an abstraction to to say, well, I'm holding 100 companies in that ETF. I don't know which ones they are. The price of the ETF is down. To me, that's a scarier proposition and a little bit more difficult to hold psychologically. But you could argue it in reverse too and say, hey, I'm confident in the ETF and I don't need to know the stocks in it and I'm going to hold no matter what. So it does come down to individual preference and how you think about it. For me, I'd rather know the businesses I'm holding and recommending. So that's why we do individual stocks.
Yeah, I think it is a bit of a shortcut to own something like the SCHD. You can look up what's in the holdings, but with like broader index funds, that's been really the big movement, passive investing, which I still think is appropriate for most people. I mean, people who invest in dividend stocks are interested in the businesses. They enjoy investing, whereas people who invest in ETFs and index funds really just don't want to pay an advisor. So just throw it in an index fund and let it ride. You do come up with this issue though, that you may have values in your personal life where if you don't like a certain kind of company that might be doing something that you are morally against, and I'm not going to name any names or industries, but there are people who care about the kind of companies that they're associated with, and you do become an owner of these kinds of companies. And this ESG investing, they've tried to make that a thing where you can pay attention to, you buy an ESG fund and pay attention to the companies they own. That might make you feel better about your investments, but it's kind of wishy-washy and it hasn't really grown the way that people wanted it to. Really, it comes down to these index funds. You buy the S&P 500 or QQQ, like we mentioned, NASDAQ 100. And it's been a pretty good strategy, very low expense ratios. What's your take on index funds? I mean, it's kind of a generality, buying dividend stocks versus index funds. It's just a lot of work versus not a lot of work. And also, one of the big criticisms of owning individual stocks is that you're not going to beat the market. And it's a pretty valid argument. If you invest in the market, you're going to make the market returns. If you invest in individual stocks, you're not probably going to meet the market returns over time. But as we talked, like that's not necessarily the goal of a dividend growth strategy.
Yeah, no, completely. So if you want to buy individual stocks and beat the market, I'd say the best bet you have is to follow a momentum strategy, which there's momentum ETFs too, which have done pretty well. But yeah, if your goal is to build rising dividend income for retirement, individual stocks give you the best amount of customization and individualization. So as you mentioned, ESG, some people might not want companies that are in ESG. There's so many different, everyone has their own moral code. What's that?
There's the Vice ETF, I think, that's just all, cigarettes and booze.
Well, yeah, I mean, a person might not want to invest in Nike, or the person might find the healthcare industry reprehensible, but love, Colgate or something. I don't know. Yeah. Like everyone has, if you got poisoned from bad water from 3M, then you're probably not going to want to buy 3M stock. But, 3M maybe have great ESG scores in some ways and other ways, maybe not 3M specifically, but you could look at like a pharma company. Some people might hate those. Some people might think they're amazing, and ESG might not capture that to the level of individualization that you're looking for. And aside from moral codes, because a lot of people just don't care at all. Like, I look at investments as investments, and as long as they're not, I don't know, I don't look at that too much in what we recommend, because everyone's so different in that. But one of the beautiful things about individual stocks is if you're like, hey, I need 4% plus yields, you can invest exclusively in stocks that yield 4%. And every stock you buy has that yield when you start. You could know what growth level you need, and you can pick stocks that are likely to grow faster. You can have a value bin to your portfolio. You can really customize. You can load up more on one sector. You could say, hey, I'm very bullish on healthcare and I'm very, bullish on insurance. And you could have a healthcare and insurance portfolio that's heavily weighted towards that. So I think just the level of customization, it goes beyond just like, well, if your only goal is to beat the market, that first of all, if your goal is to beat the market, you can't typically invest in ETFs because you're only going to match the market. But you have to match your portfolio to your individual preferences and goals. And I think individual stocks are the best way to do that if you're willing to take the time to do it. And if you're not, the ETFs make a phenomenal option outside of that.
Individual stock investing takes up a significant amount of time. Newsletters like yours just reduce the amount of time that you need to spend on your research. either, if you're looking to buy a new stock, it's a really good filter. And if you're just monitoring a portfolio, you've got the stock sell recommendations or the dividend safety score, which is in your newsletter. Those are just really good ways to monitor a portfolio if you're done building it or if you're starting to reduce it like I am. All right, Ben. So thanks for answering all these questions and this conversation. So we at the beginning we teased your top 3 dividend stocks. Right now, we're recording this on May 7th, 2024. So let's hear your top 3 dividend stocks right now.
Absolutely. So all 3 of these are from the most recent edition of the Sure Dividend newsletter, which just came out the 5th. The first one, and they're not in any particular order. The first one I'll mention is Comcast, obviously a very well-known company. People, when they think about Comcast, you think of cord cutting and how this is damaging the company. Their earnings per share have increased every year since 2020. They hit all-time highs in earnings per share in 2021, 2022, 2023, and are projected to in 2024 as well, growing pretty consistently. We estimate 8% growth on a per share basis for them. A good portion of that growth actually comes from share repurchases. So the company generates tremendous cash flows, which they use to pay dividends and repurchase shares. And they've been around since 1963. So we recommend Comcast. It has a nice mix of growth, which I just mentioned. And at the time, at the report I'm looking at, a 3% plus dividend yield. I think it's still around 3%. Theme parks.
Yeah, they own Universal,
they do a lot.
Universal Florida, which is like an incredible thing. They just built a whole new world down there. They're building a new amusement park. We went down a couple years ago. Really big brand. I've never thought of it as an investment because of the cord cutting and just thinking about how frustrating it is to call customer service. But they have a lot of businesses. It's a very, very large company.
Well, I have to mention I actually had a good experience with their customer service recently. Okay. So I'll just mention it because it never happens. It came after a year of bad customer service. So we have a cable line in our backyard that I wanted to get buried. And I went in a circle with them for a year. And then I finally got a guy who was amazing. And he was just like, yeah, I'll get that taken care of. And they did it for free. So if you find the right person, they can have good customer support. But yeah, I agree. They're not known for it. But if you didn't know what they did and you just looked at their earnings per share growth, you'd say this is a growth company as of now. So people don't really see that when they get caught on the story of, everyone has Netflix, which a lot of people have Netflix and cable. It's not always either or. But that's the first one. The second one I wanted to mention is PPG Industries. So they're the world's largest paint company. There's only 2 other companies in the same broad size class as them. So they're basically a oligopoly with Sherwin-Williams and AkzoNobel, which is a Dutch paint company. PPG's been around since 1883. They've increased their dividends for over 50 consecutive years. So they're a Dividend King, which is the highest qualification you can get. Their earnings per share grow pretty consistently. It's a little bit more volatile than Comcast, but they're very profitable. And they have a low payout ratio. They only pay out around a third of their earnings as dividends. So the dividend's very safe. They're growing at a pretty solid clip as well. For them, actually the same as Comcast, we expect about 8% growth on a per share basis ahead. And their dividend yield's a bit lower. It's at 2%, which is at the time of the report I'm looking at. So it's probably around 2% still, which is about 50% higher than the S&P 500, but not like you don't buy it for today's income. It's more of a dividend growth play.
I own PPG, and it's a Pittsburgh-based company. I'm from Pittsburgh, and okay. I think it was called like Pittsburgh Paints and something.
And Glass. Pittsburgh Paint and Glass. Yeah.
I don't think they go by that anymore, but no. So I have some history there. My neighbor, he used to work for PPG, and he had a patent for paint, and his patent was pretty cool. Like he was able to invent this paint that somehow you put it onto like a skyscraper, and then like they did something to it and it would get like turn into a mirror, like metallic. So his paint's on the Louvre in France. And when you're watching like the opening of Dallas, the TV show, there's a building, and my neighbor used to be like, yes, that building has my paint. He'd always make a big deal about it, but he had the patent on his wall. And it was one of those things where like he invented the paint, and then he was just a salaried employee. So he got the certificate, but PPG got the, all the
royalties,
all the royalties from the whatever the process was to make the paint.
That's very interesting. And yeah, it's kind of said that they should have given him some royalties, I feel like. But
And I think he got early retirement. They told him get lost in 2007. It was kind of like kicked him on the way out the door, but he still has the patent and he can still brag about having his paint on the Louvre or wherever else it is in the world.
But yeah, it's a high quality company, high margin, low payout ratio, solid growth. The third company I wanted to mention, which is also in the Sure Dividend newsletter for May, is United Health Group. They're a healthcare insurance company. They're actually one of the 20 largest publicly traded companies in the US. Their market cap is over $400 billion at the time of this report. They've increased their dividend for 14 consecutive years. So that dates back to, it's not as far as back as, like a PPG, but it's a solid streak. Their results have been incredible. Earnings are up about 5 times over the last decade. They've grown basically nonstop since the changes in US healthcare 12 years ago or whenever. Earnings per share have been up every year since at least 2014. So they have at least a 10-year streak of consecutive earnings per share increases. We're expecting solid growth ahead as well, probably in excess of the first two I mentioned, first two companies. The downside to United Health, they don't have a high dividend yield. It's 1.6% at the report I'm looking at. So just a bit above the S&P 500, but the growth should be ahead of the S&P 500, and the company has high marks for safety. The payout ratios under 1/3 of earnings, and the company's pretty recession resistant as well. People don't tend to cut their healthcare. It's not where you want to save money.
I thought I heard about some sort of breach. Was there some sort of like a breach, like a data breach recently? And maybe that's why, is the stock price down? It might be providing a little bit of value now.
Yes, the stock price is down a bit from the data breach, which I view that as I don't think anyone will be talking about that in 3 years. And that's one of the things you hope to find is, it's a Warren Buffett quote of, he looks for businesses that are in temporary trouble, keyword being temporary, because then the price is down, but a couple of years from now, no one cares about the short blip of trouble, but you got to pick up shares at a cheaper price. UNH might be a very minor version of that. I don't think the share price came down massively.
All right, so just to recap there, we had, first one was Comcast. What's the symbol of Comcast? I always forget that one.
It's a longer one, which is kind of unusual. It's CMCSA.
Right. PPG, which is Pittsburgh Paints and Glass, but it's now just PPG. That's the symbol. And the last one, United Healthcare, UNH.
Yes, United Health Group, UNH.
All right, Ben, so thanks for those 3 stock ideas. That concludes our interview. Can you tell people where can they find you on the internet?
Yeah, you can visit suredividend.com. That's where you can find our work. We do a lot of free work. It's saying free, but it's high quality analysis. We have lists for Dividend Kings, which are 50 plus years of dividend increases, monthly dividend stocks that pay dividends monthly. Although in general, those tend to be lower quality. Just a word of warning, high dividend stocks. We do a ton of analysis for free. So come check us out on suredividend.com. We're on a lot of social media. We share our articles on there. I'm not particularly active on it though. But yeah, the best place is just our website. And you can feel free to email us. Our email address is at the bottom of almost all our articles. So support@suredividend.com. Either myself or a key team member will answer any questions. We don't provide personalized investment advice as newsletter providers, but we can answer any general dividend investing related questions.
Yeah, and if you sign up for your email list on the website, you get a weekly update on different articles that you've published. All of it's free. So you guys have sort of like a newsletter that's for everybody. And then, of course, the paid newsletter, Sure Dividend, the different ones you talked about before. All right, Ben, well, thanks for joining. This was my first interview 10 years ago. There were a lot of dividend bloggers. Kind of fun to reminisce about those days.
Here's to the next 10 years and beyond.
All right, thanks, Ben. Thanks to Ben Reynolds of the Sure Dividend newsletter for this conversation. In the description below, he's offering a free download. It's a spreadsheet of the 54 Dividend Kings. Those are companies that have paid and increased their dividends for the past 50 years or more. If you like this video, please subscribe to the Retire Before Dad YouTube channel, where I talk about personal finance and DIY investing for financial independence. Head over to my website and subscribe to my email list. You'll get another free download, 7 Bedrock ETFs for DIY investors. As always, don't rely solely on newsletters, YouTube videos, or stock picks for buy and sell recommendations. Always perform personalized due diligence before investing. Thanks for watching.